Thank you for joining today's webinar. Learn how active traders benefit in security file 2015 tax returns for maximum tax benefits. Please be aware this information is provided for educational purposes. It's not a recommendation or endorsement of any investment tax strategy. The presenter, Bob Green, is not affiliated with Lightspeed Trading. The content and perspective is solely attributed to the presenter. Lightspeed Trading does not give out any tax advice or recommendations, so this is solely for informational purposes, not to be considered advice or recommendations by Lightspeed itself. We are pleased to have Bob Green from GreenTraderTax present. Mr. Green is the leading authority on trader tax. If you ask anyone in the trader world, they will point to Bob as one of the authorities. So he is well known and well versed in all aspects of trader tax, and a lot of this information is very useful in many different areas for filing. So we are very happy to have him back to help our clients and prospective clients learn some more information on the tax information. So without further ado, I'm going to shift over the presentation to Bob, and he will be able to get going here. And certainly you'll be able to view this information on the website. It will be recorded, and you could email us any questions or send us questions as we go, and we'll try to get to them by the end of the presentation. So here we go. Here's Bob. Take it away.
Thank you, Rob, very much. Again, it's learn how active traders in securities file 2015 tax returns for maximum tax benefits. So you're sitting here today getting ready to file your tax return for last year. You're waiting for your 1099-B. They will come in from the brokers over the next month, as Rob pointed out. They're a very difficult undertaking, those 1099-Bs, and they're packed with a tremendous amount of information. But guess what? For almost all traders, especially active traders, it doesn't have all the information you need. You may as well just do a download of original data using proper software to generate your Form 8949. You can do that now and reconcile to the 1099-B, and there will be differences. I'm a CPA and managing member of Green Neuschwander Manning LLC, otherwise known as G&M Trader Tax, and GreenTraderTax, our main brand and website. Thank you, Rob, for the introduction and bio. I'm the author of Green's 2016 Trader Tax Guide, the original tax guide for traders from McGraw-Hill in 2004. I wrote the Business of Trading column for Active Trader magazine. I'm a frequent blogger in Forbes. Recommended by Barron's Wall Street Journal. 2 weeks ago, Barron said I was their go-to trader tax guy or go-to tax guy. And this past weekend, Wall Street Journal had my information about WAR sales, about this problem of apples and oranges between what the brokers put out, according to the IRS rules for brokers, which are different from the IRS rules for traders. And you'll see me in all the leading media. And you saw me just yesterday at the Traders Expo, or 2 days ago at the Traders Expo in New York City. Our CPA firm is focused on investors, traders, and investment managers. We're nationwide. Our biggest markets, California, Texas, New York. We focus on tax compliance, preparation and planning, accounting, getting this information right versus the 1099-B, consultations about whether you have trader tax status, whether you need an entity. We actually form your entity, and we handle IRS controversy and state controversy if you get audited. Rob pointed out some of the disclaimers. It's educational. It's not one-on-one advice. I do encourage you to ask questions on the board today. I'll try to get to some of them. Keep them very short and general. I do encourage you to get one-on-one advice. We don't give investment advice. We just give tax advice. We're not lawyers. We do have tax lawyers working for us. Now, as Rob pointed out, I, Robert Green, and our companies are not affiliated with Lightspeed Trading, and Lightspeed is not responsible for any of this tax content. That's always the case with brokers. Let's start with trader tax status. Learn how to save thousands by claiming trader tax status on your 2015 tax returns. Many Lightspeed traders qualify. Lightspeed specializes in very active trading platforms and with great low commissions. So their clients match up really well with our client specialty, which is trader tax status. Conversely, there's lots of traders out there that they may make only 5 trades a week, where we're looking for 4 trades a day. Now, trader tax status, TTS for short, is a 3-pronged benefit. 1, business expenses are fully deductible, whereas your typical trader has investment expenses which are limited on Schedule A as miscellaneous itemized deductions. The business trader saves about $5,000, $10,000, $15,000 or more just with business expense treatment. Investment expenses is for the birds. No home office, no education, 2% AGI limitation, no deduction for AMT, piece itemized deduction limitation, state limitation. Most ends up on the cutting room floor. Now, trader tax status allows a Section 475 mark-to-market accounting election. That exempts you from the onerous wash sale loss rules and the capital loss limitations. If you lose $50,000, if you lost that in 2015, you don't want to be stuck with a $3,000 capital loss limitation and have to carry over $47,000 to 2016. You would rather have a full ordinary business loss, and 475 gives you that. It also exempts you from those wash sale loss deferrals at year end and with your IRAs throughout the year. The third benefit, if you house your trading activity in an entity like an SCorp trading company, or you have a trading partnership with a C-Corp management company, you can have deductible employee benefit plan deductions, including retirement plans and health insurance. Your sole proprietor trader can't have those deductions. They don't have earned income. We need the entity to create the earned income. Plus, it just looks a lot better to the IRS, and it ring fences your trading from individual activity. That helps with wash sales. It helps with application of 475. It helps with how trader tax status looks. A lot of you Lightspeed traders should really have an entity. Your data feed fees will cost a little bit more, but the commissions are so low and the tax benefits are so great, it's really worth it. Now, the business expenses are fully deductible, Section 162 with trader tax status. That's the home office, the education. Section 195 startup expenses, you can go back 6 months from when you start. So if you started July 1st, 2015, you could go back to January 1st, capitalize your startup costs, expense $5,000 and amortize the rest over 15 years. Margin interest is business interest. Section 179, 100% depreciation. If you have wages or income from trading, it's 100% deductible. Anytime you buy a piece of equipment for under $2,500 under the tangible personal property regs, which were just changed by the IRS, it's fully deductible. It's fully expensed. You don't even run it through depreciation. Amortization on software, seminars, market data, and much more. Coaching, it's all fully deductible. Now, your commissions are not separately stated expenses. Those are part of your trading gains and losses. So again, business expenses are deductible from gross income, which is far better than restricted investment expenses. Now, if you're an individual and you use trader tax status, you're called a sole proprietor. And like other sole proprietor businesses, traders may add a Schedule C for reporting trader tax status business expenses. So we're going to go through how to qualify, and if you feel you qualified for 2015, you can add a Schedule C and put in all your business expenses. Not your trading gains and losses. Those go on other forms, and more on that later. Now, if you traded in an entity account, and you have to trade in the entity account, you can't just have an entity and trade in an individual account. If you trade in a pass-through entity like an SCorp or a partnership tax return, you claim trader tax status by using business expense treatment on the 1120S for the SCorp or the 1065 for the partnership. And you don't use investment expense treatment, which you would put on the Schedule K1 as a pass-through item. We don't have example tax returns in this presentation today. Qualifying for trader tax status, but I'm going to, by the way, explain to you how to prepare a tax return. So let's talk about qualifying for trader tax status. While no TTS election was required, you do need to qualify. And you're going to see after we go through these golden rules that many Lightspeed traders qualify. Again, no election is required for trader tax status. The IRS doesn't require one. If you qualify for all or part of the year, you're entitled to use business expense treatment on your 2015 tax return for that portion of the year. In fact, you can even amend old returns that are still open. Usually 3 years are open, and add a Schedule C. Now, don't confuse trader tax status with a sister concept of Section 475 mark-to-market accounting, the tax loss insurance. Because the 475 does require a timely election. So many local accountants will botch this on you. You can go into almost any tax storefront office or use any tax software, and they won't even bring these concepts up, even if you tell them you're an active trader. And they'll think, well, because you didn't elect 475, you can't use business expense treatment. That's wrong. Or they will think because you can use trader tax status business expense treatment, you can also use ordinary loss treatment for your trading losses. Both of those are wrong, and you'll cause yourself an audit and some big problems. So let's go through Green's golden rules for trader tax status. Substantial volume. Makes 720 or more individual trades per year on an annualized basis. Count trade confirmations and separate legs of complex options trades. Do not count option exercises and unexecuted trades. Now, if you started July 1st, notice that number is half of 720 because it's an annualized number. Substantial proceeds. Has proceeds in the millions of dollars per year on securities. Less is okay on options, futures, and Forex. Regularly trades full-time or part-time for a good part of the day almost every day. Frequent. Executes trades on more than 75% of available trading days. That's close to 4 days per week. So far we're talking about 4 trades a day, 4 days a week, 45, 50 weeks a year. You do the math, you get to the 720. That just came out of the Pope ruling, P-O-P-P-E. Before that, we were looking for 1,000 trades, being a little more conservative, but Pope squeezed by in a tax court case with 720 trades, 60 a month. Continuous. Has few to no sporadic lapses in the trading business during the year. 1 month on, 1 month off is not acceptable. Time. Spends more than 4 hours per day, almost every market day, working on his trading business. That's trading, research, and administration, not just trading. Holding period and daily market movements. You're making mostly day trades or swing trades, and the average holding period is under a few weeks on equities and no more than 31 days on options. Now, actually, in total, the holding period average has to be 31 days or less. That came out of the Endicott tax court case, otherwise known as the Endicott court. So volume, frequency, and holding period are the 3 big factors, and holding period is actually the biggest factor. Intention. You need to have an intention to run it as a business-like activity, as a business, as a job, to make quote-unquote a living. It doesn't have to be a primary living, and you can have perennial losses, as the hobby loss rules don't apply to a trading business. If you get a tax notice and the series of questions from the IRS comes right out of the hobby loss manual, and you can recognize them pretty easily, you want to defeat that quickly with a rebuttal. Trading is not personal or recreational in nature. The hobby loss rules don't apply. The passive activity loss rules from Section 469 also don't apply, and you don't need material participation. Actually, your hours will be greater than material participation, but it's not a passive loss activity under the trading rule. Otherwise, everyone with a passive loss limitation would just invest in a hedge fund with trader tax status and have passive activity income. But that's not the case. So make sure you have the right intention to run it like a business, a job, to make a living. Even if you're losing, your intention is to make a living. Now you need a significant business setup, plenty of business equipment. Most traders have multiple computers, and most of them have 3, 4, 5 monitors or huge screens that fit many, sub-screens. Many have education with trading schools or academies, and several business expenses and a home office. Do not be shy from deducting the home office. The IRS knows that America works from home offices. And in 1999, they liberalized it. That's decades ago. It doesn't require customers to come to the office or to be your main office. Excuse me. So don't be shy about that deduction. Now, it does require income, and I'm going to show you later how to transfer some income to Schedule C to unlock that deduction. That's a huge deduction for traders, including the depreciation on your home, and you'll still get the home exclusion on sale. Now, the last factor, materiality. You need to have a material account size, $25,000 for equities, and you need that to be a patent day trader anyway. Now, you can have less for futures, options, and Forex, but you don't want to go below $15,000 because then it just doesn't look material to the IRS. What doesn't qualify for trader tax status? If you engage an outside investment manager, a CTA, an RIA, they're making the trades, not you. So even if they make enough volume and frequency of trades, there's no trader tax status on that account because you're not flying the plane. Now, you can use automated trading systems, but you need to be very involved with them. If there's not much involvement by the trader and you just buy a canned software, you're not going to get credit for trader tax status. You need to create the program or be very involved with manipulation of the program. Again, you're flying in a plane. You got to be in the cockpit for trader tax status. If you're a passenger, there's no trader tax status. You can be a pilot with automated controls and manual flying as well. Now, if you're trading in retirement funds, that doesn't qualify for trader tax status. Could be a good idea. Just make sure it's not a prohibited transaction. If you personally guarantee the account, pay yourself a fee, you blow up your IRA. It all becomes taxable funds and penalties. You don't want to do that. Let's break for a second. All right, so far, we said, hey, if you qualify, and I know a lot of you probably do, you're thinking to yourself right now, I passed the golden rules for all or part of the year. I have a chunk of expenses. I want to deduct them. Let me work with TurboTax to add a Schedule C to do it. Let me tell my local accountant about it. Or let me engage GreenTraderTax to do it. Now, you're going to need a footnote. There are special strategies. And let's talk about it now. What are you going to do? Well, you're a sole proprietor trader, and you need to learn how to file a sole proprietor Schedule C with effective footnotes and other strategies so it's not a red flag in the eyes of the IRS. Which forms to use? The IRS hasn't created specialized tax forms for an individual trading business. Traders enter gains and losses, portfolio income, business expenses, and investment expenses on various forms. It's often confusing to the IRS and local tax preparers. Sole proprietor, Schedule C. Other sole proprietorship businesses report revenue, cost of goods sold if they have an inventory and product, and expenses on a Schedule C. It all goes in one place. There's a net income, there's self-employment income, self-employment tax. It's a pretty neat package. But business traders qualifying for trader tax status report only expenses on Schedule C. Trading gains and losses are reported on various forms depending on the situation. So you got Form 8949 for securities. Sales of securities must first be reported on Form 8949. That feeds into Schedule D. That's the cash method or the realization method. And you got the capital losses limited to $3,000 per year against ordinary income. The rest is the capital loss carryover. Now remember, your capital losses are unlimited against capital gains. But after you use up the capital gains, there's $3,000 allowed against other income. Now here's the big problem with Form 8949. The brokers want you to believe that they're going to handle this for you. But unfortunately, they're not. Not Lightspeed. Lightspeed puts me in front of you. They tell the full story. But some of the brokers want to just give you the impression you can download the 1099-B into TurboTax and be good to go. You're not. It's wrong. You got to read the full story on our website. That's why I've been in Barron's in the Wall Street Journal. Because you need to make wash sale loss and other adjustments on Form 8949. Active traders generally can't rely on 1099-Bs for these adjustments. We'll cover this more later. Now, what about Form 4797 and Form 3115? Those come into play for Section 475, mark-to-market accounting. Business traders who elect and use Section 475 MTM on securities report their business trades line by line on Form 4797 Part 2. Form 4797 Part 2 is ordinary gain or loss. There's unlimited business ordinary loss treatment. Now, ordinary income is taxed the same as short-term capital gains. But ordinary losses are so much better than capital loss limitations. That's why we recommend 475 on securities only, not on 1256 contracts, so you can retain the lower 60/40 tax rates on those. So you're avoiding the capital loss limitation, avoiding the wash sale loss treatment, and you have business losses that comprise a net operating loss, an NOL, which you can carry back 2 years and or forward 20 and get huge refunds right away. Now, if you need to also file a Form 3115 change of accounting method if you elected Section 475 for 2015. So if you made that election by April 15th of 2015, you're going to be using Form 4797 for your business trading and securities, and you're going to file the Form 3115. And you probably need our help in doing the 3115. Now, if you trade Section 1256 contracts, it's pretty simple tax-wise. You can rely on the one-page 1099-B because it's mark-to-market accounting, summary reporting. They show you realized and then unrealized and then aggregate profit or loss, and that's on your 1099-B that comes from Lightspeed 2 through Wedbush. And you just take that summary number and put it on Form 6781 Part 1. Now, if you have a large Section 1256 loss carryback, consider the Section 1256 loss carryback election to carry back those losses 3 tax years, but only applied against Section 1256 gains in those years. It's a limited carryback, but it's a powerful carryback. If you want this election, you're going to check box D on top of the Form 6781 for the election. Then you're not going to put the losses on your 2015 tax return. You're going to carry them back 3 years. Whatever you can't use in the 3rd year back, you go to the 2nd year back and then to the 1st year back. Use our firm to do it so you do it right and you don't delay it and have questions from the IRS. Now back to the Schedule C. There are red flag issues. This is the important point about a Schedule C. Now we have a fix, and we want you to use the fix for 2015. Better off engaging our firm to do it, but you can try it on your own too. But we prefer that you go into the entity for going forward. So you use the Schedule C for 2015 and 2016 year to date, and then you get yourself into the entity for the rest of the year. Now, sole proprietor business traders report the business expenses on Schedule C and the trading income loss, portfolio-related incomes on other tax forms, interest and dividend on Schedule B, and I just told you the other forms. And also your investments go on all those other forms. So how is the IRS to know where your trading business income is? All they see is a Schedule C with expenses, 10, 15, 20,000 of expenses. And they think that it's an unprofitable business, and they think you're crazy. Why would you do that? Now, you do say trader in securities or trader in commodities, so they have an inkling, a clue, but their computers are all botched up. So you need to mitigate this red flag, and I advocate a special strategy to transfer a portion of business trading gains to Schedule C to quote-unquote zero it out. So you're going to transfer trading gains to Schedule C, but you're not going to show a net profit, because that would also flip out the IRS computers to think that you have self-employment income, which you do not, because trading gains are not self-employment income, with the exception of traders who are full members of a futures or options exchange and trade Section 1256 contracts on the exchange. According to Section 1402I, the self-employment rules, that exchange-generated trading is earned income. That's only for a full membership. If you have an electronic corporate membership, that doesn't count. So the idea of the transfer is to zero out the Schedule C so it's not a red flag, and so your Schedule C in the tax office says minus $15,000, and your home office carryover is $10,000. So you need to transfer $25,000 to zero out Schedule C and unlock the home office and unlock the 100% depreciation. Otherwise, your home office, except for the real estate tax and mortgage interest portion, will be a carryover. That part's allowed with that income, but all the rest of it, remember, your home office, it might be 10 or 15% of your home. Every dime you spend on that home goes into the calculation, and you get that 10 or 15% of it, whatever you're on the square footage method or rooms method. Now, there's an alternative to the income transfer. You could actually report the gains directly on the home office form, so the IRS knows how to tie those two schedules together. And then you're going to have that Schedule C loss, which is the red flag, but that might do you some good, because if your spouse has self-employment income and owes self-employment tax, or you have other self-employment income, this can zero it out. You can use those expenses as a SEI reduction. And it can also reduce your Obamacare net investment income tax. So that's why people hire us to do their taxes, because there's a lot of different ways that you can go about this, and you need to go about it in the way that produces the most tax savings with a good-looking tax return. And you got to include footnotes. I strongly recommend that business traders include well-written tax return footnotes explaining the trader tax law, explaining what it is to qualify, how and why, how you qualify, why you're using the treatment, if you made the 475 election or a Section 988 4X election, if you did the income transfer strategy, if you're part-time, how you qualify. You have to nip IRS questions in the bud with a good footnote, and this is what keeps you from getting audited or getting a notice. We have an incredible record of success, and we attribute it to the footnotes and the proper reporting strategies and following instructions properly. So many local accountants botch reporting. They botch the 1099-B, they botch the wash sales, they put trading gains on Schedule C, they miss the 475 election, they use it when they don't qualify, they don't use it when they do qualify, they miss the 3115 filing, they're late with that. There's a whole litany of ways that things can go wrong. Now, it's a lot better with an entity. And you're going to unlock the employee benefit plan deductions, the health and retirement. You're going to solidify trader tax status in the eyes of the IRS, whereas a sole proprietor is a bit of a red flag. You're going to unlock the employee benefit plan deductions, the health insurance and retirement plans, whereas a sole proprietor trader may not have these deductions. A sole proprietor can't pay themselves a salary or a fee. So if you're single and a full-time trader, you have a Schedule C for all your business expenses. You do the income transfer strategy. You're successful. Great. Maybe you use 475, mark-to-market accounting. Two of the three pillars you're taking advantage of, but you're not able to deduct your Obamacare health insurance premiums. So you're losing a deduction of $5,000 or $10,000, and you can't contribute to a retirement plan. If you follow our strategy, you can have a trade in an SCorp, pay yourself a salary. First of all, the health insurance portion of the salary is not subject to payroll tax, and you get the deduction automatically. And then you do a salary just for a solo 401k elective deferral of $18,000. You pay payroll tax of 15.3%. Your income tax savings, federal and state, is at 40%. You put 25% of $18,000 in your pocket net. Plus you paid into Social Security and into Medicare, which you want to do if you're young, because you want to get Medicare in retirement. And it's more flexible for electing, revoking, and protecting use of a Section 475 election. S-Corps are best because you just simply pay compensation. Now, it's very difficult to achieve this strategy on a partnership tax return because the partnership pays you a fee. That part is good. But then you have to pick up your share of the partnership loss from the fee, which drains the earned interest back down to zero, and you didn't get where you need to be. The S-Corp does not pass through expenses, so you do get to be where you want to be. Now, in California and New York City, you might need two entities. New York City doesn't acknowledge S-Corps. So you need a C-Corp management company and a trading general partnership, and the C-Corp can be your partner in the partnership. California has a small tax on S-Corps, 1.5%. So if you're making a lot of money, you might want the dual entity structure there too. But usually you keep it real simple with the S-Corp. The S-Corp files an 1120-S. Everything is consolidated on that return. If you have mark-to-market accounting, you have $100,000 of trading gains, you have $25,000 of expenses, you have salary, you have a retirement plan contribution, you have some net income of $30,000. It flows through to your return as a positive number. It looks beautiful. Partnership is similar, but you don't have salary with a partnership because the partnership can't pay salary to an owner. It can only pay a guaranteed payment, but the IRS doesn't want to see that in an investment company. But again, as I explained, it doesn't work with a partnership for those deductions. Both of those entities pass through a K-1. So if you don't need employee benefit plan deductions, your spouse has the health insurance at work, you don't want a retirement plan deduction, you can have a simple spousal general partnership. Now, you may just prefer to be a sole proprietor trader with Lightspeed so you don't pay additional data feed fees, $50 or $100 more a month on your data. Now, pass-through entities are tax filers, but they're not taxpayers. They pass through the income to the individual who is the taxpayer, but in summary form. Now, retirement plans. You can save more in income taxes than you pay in payroll taxes and enjoy tax-free compounded growth trading in the plan. So the solo 401k plan is best. It combines a 100% deductible elective deferral of $18,000 for 2015 and a 25% deductible profit sharing plan. There is also an elective deferral catch-up provision of $6,000 if you're age 50 or over. Together, the maximum tax deductible contribution is $53,000 per year. Just need wages of $140,000 to get there, and $59,000 if you're 50 or older. Now, if you're making big money every year and you're a little older, consistently higher income business owners, including trading businesses with owner employees close to age 50, should consider a defined benefit retirement plan for significantly higher income tax and payroll tax savings versus a defined contribution plan. You can go up to the maximum compensation of $265,000 for 3 years. After that, you don't even need compensation, and the payroll taxes can stop. The actuary will tell you need to accumulate $2.5 million, and then you'll be able to catch up to that fast. You probably can have a tax deductible contribution of $150,000, $200,000, $250,000 a year, depending on how many years to retirement. And the actuary crunches those numbers. It's an unbelievable plan, but you got to be consistently high income and have the cash flow to be able to fund it. Now, let's get into the nitty-gritty of wash sale losses. Let me just sip some water here. So I want you to learn how to deal with onerous wash sale loss reporting on securities. If you trade equities and equity options and or have multiple brokerage accounts, you can't rely on brokerage firm Form 1099-Bs for reporting wash sale losses correctly. So again, you trade equities, you trade equity options in the same account, and you just have one account. The broker is only going to report wash sales between the exact symbol. You need to do it based on substantially identical symbols. The equity and the equity option are substantially identical. Apple equity is substantially identical to Apple options at different strike prices at different exercise dates, expiration dates. Broker doesn't do it that way. Now, let's say you only trade securities. You don't trade equity options, and you have a Lightspeed account, but you also have some other brokerage accounts for investments, and your spouse has some accounts, and you have some joint accounts, and you have some IRA and or Roth accounts. You got to calculate your wash sales across all those accounts. No broker does that. They only do it based on the one account. So you can see a little bit of a disconnect brewing here. Now, what the heck is a wash sale? It's all about tax losses versus economic losses. IRS wash sale loss rules, Section 1091, are written to protect the U.S. Treasury against taxpayers taking tax losses at year end. You know, at year end you want to harvest your losses to lower your tax bill. So you sell some symbols towards the end of December, and you don't want to miss the rally. We didn't have one this year. We had a sell-off, but you don't want to miss the rally the first few weeks of January, so you get back into the positions. The IRS is saying, wait a second, you're taking a tax loss on me, but you got right back into the position. You're not really taking an economic loss. So what? You paid a commission, a rock bottom low commission to get back in? They view it as not being economic. So here are the wash sale loss rules in publication 550. A wash sale occurs when you sell or trade stock or securities at a loss, and within 30 days before or after the sale, you buy substantially identical stock or securities. Notice that word, substantially identical. Acquire substantially identical stock or securities in a fully taxable account trade. Acquire a contract or option to buy substantially identical stock or securities. Or acquire substantially identical stock for your individual retirement account or Roth IRA. Now, we have called the Chief Counsel's Office of the IRS and spoken to the top attorneys there and gone through this painstakingly slowly with all our content, and they've absolutely confirmed it, that it's between stock and stock options in the same security and between taxable and IRA accounts, and that those are the rules for taxpayers, but not the rules for brokers. They don't want to overburden brokers. They're already burdened with the cost basis regulations. It's not the broker's fault. Brokers are following their rules. The rules are different. It's Congress's fault, the IRS's fault. They need to fix this. Brokers calculate wash sales differently from taxpayers. Brokers calculate wash sales based on identical positions, an exact symbol only per separate brokerage account. Section 1091 requires taxpayers to calculate wash sales based on substantially identical positions between stocks and options at different exercise dates across all their accounts, including IRAs, even Roth IRAs. If you sell Apple stock in your taxable account at Lightspeed and happen to buy it back, knowingly or without realizing it was a wash sale issue, in your IRA that you hold with a different broker, you can't take the loss in Lightspeed because you bought it back within 30 days in your IRA, so you can't take the loss in Lightspeed, and there's no way to record the loss in your basis in the IRA. You permanently lose that loss. How do you fix that? Well, trade in an entity, which is a different taxpayer identification number, but still it's not a perfect fix. Because if you purposely avoid a wash sale between an entity and an individual account, the IRS can apply Section 267 related party rules to grab it. So the safest thing is to use mark-to-market accounting, so there are no wash sales. And also, if you're not using mark-to-market accounting, do not trade lists. So if you trade the tech stocks at Lightspeed in your taxable account, don't trade those in your IRA. Now you should use software to calculate wash sales across all accounts. So if you actively trade equities and equity options and or securities in more than one account, unless you use proper software, all your individual taxable and IRA on all those accounts, you will probably handle wash sales wrong and either underreport or overreport. Now, most people assume that if you are remiss on reporting wash sales, and you, let's say you just use the broker 1099B or just import the 1099B into TurboTax, and say, I don't want to bother with this, I want to play ignorant. My accountant doesn't want to bother with it, he doesn't know what software to use, this is a minefield for him, we're just going to skip it and use what the broker gives us. And after all, it probably picks up less wash sales, and that's better for me, and I'll play the audit lottery. We never give advice to play the audit lottery. We only give advice to do it right. But let me point out to you that it can go the other way. Here's an example. You sell Apple stock at a loss. You buy Apple options and sell them at a large gain. That gain on the options absorbed the wash sale on the stock, melting it away, and you actually don't have a wash sale, whereas your broker picks up a wash sale. Or you bought it back in another account, the stock back in another account where there was a gain. So you can't assume that sticking your hand in the sand like an ostrich and not doing it right and not using the software will be better for you. It could be a lot worse. And it's wrong. So in these cases, you can't rely on the 1099B, you can't just import it into TurboTax, and you need software. So go to our website, click on the accounting area of the website. You'll see that we offer a service where we do that for you, but you can also get a retail license to TradeLog, which works very well with Lightspeed. They worked on a filter. TradeLog works with almost all brokers, and if it doesn't, you can download into a CSV file and then into the software. You're downloading original transactions, not 1099Bs. And you're downloading it from all your different brokerage accounts. So it's doing a consolidated wash sale loss analysis. So you can get a retail version of the product, or for the price of the retail license, you can hire us to do the work for you, and we can handle all these difficult concepts for you. Now, if it's very complicated, it may take us several hours of time, in which case it will cost more. But if it's just 1 hour, it's a better deal. So come to our website to learn about that. Now, we didn't want this. Believe me, we would prefer it was like futures and that we could just rely on the 1099B. We want the IRS to fix this so it goes away and it's not a problem. But we saw this coming when they came out with the cost basis regulations, and we said right off the bat, if you go from reporting 10% of the activity to 90%, unless you're reporting 100%, it's not what a taxpayer needs. It's missing too much. Let's look at a 1099B. So Rob sent me over a 2014, because the 015 are not out yet. He sent me over this file, and it's redacted for client information. Now, you'll see Bush Securities because that's the clearing firm. So you see up there, you see dividends and distributions. That's easy. You just enter that in Schedule B. And if you see regulated futures contracts, those are your 1256 contracts. Notice profit or loss realized. See if I can make it a little bigger. I probably can't because it's in PowerPoint. And then you'll see unrealized profit or loss. That's the adjustment of mark-to-market year. And then aggregate profit or loss, just take that and go to 6781. So this one over dividends, Schedule B, this one to 6781. It's real simple so far, but then they see proceeds. And hopefully you have no OID and other adjustments for interest. That's very quirky. But you see this, then you get into the proceeds and the cost basis reporting, and you see these W wash sale loss adjustments. So you buy and sell Apple stock or Alibaba stock every day of the year. You're a day trader. You focus on 4 symbols, 5 symbols. That's what you know. You trade them every single day. Every time you have a loss, there's a W, and it's punted to the next cost basis. Well, you know something? You can have this all year long. And come year end, you get out of Alibaba on December 20th. You don't get back into it until January 21st. You wait the 31 days. And there's no wash sale at year end. So even though you have these wash sale adjustments all year long, that final sale has that whopping loss in it. And it's not a wash sale because you broke the chain. Now, TradeLog has a potential wash sale loss report that can show you what's coming up and what to avoid. But again, this is just on this account, and it's just with identical positions. You got to do it on substantial identical positions across all your accounts. So even though this is a tremendous amount of work on the broker's behalf, and it gives the IRS a lot of clues about what may be your situation, it's wrong. It's ludicrous. I don't know why the IRS did that, but they did. What's your ticket out of this headache? Section 475. Learn how Section 475 exempts active traders from wash sale losses and capital loss limitations. Learn how to make a timely 475 election and whether to elect on securities only or 1256 contracts too. It's ordinary loss treatment. It allows business traders to deduct losses in the current tax year, avoiding the capital loss limitation, avoiding the wash sale losses. So you're going to get a 1089 as if you're a cash method trader, but that's not what you use on your tax return, and the IRS understands it. I don't like when brokers give the clients an option to say they have 475 and get a 1099 with mark-to-market accounting and 475. Because the broker doesn't know if they qualify for trader tax status. The broker doesn't know if they elected on time. And a lot of clients are going to abuse that, and then the broker is going to have trouble. Now, when traders have negative taxable income, it's the NOL and the carryback. I explained that before. So here are the election procedures. Now, maybe you have a capital loss limitation from 2015 because you missed the election. But pay attention now, everyone. If I've lost any of you, there was a lot of content here. We've covered a lot. I want you to snap to for a second and focus on what I'm going to tell you right now. You have a big loss this year. Markets have been crazy, whipsawed, volatile. Some of our clients are short when they need to be short, long when they need to be long. They're doing great. Other clients were long when they needed to be short, then they went short and got short squeezed, and they have big losses. I don't care what your capital loss carryover is from last year. If you have a big loss, you probably should elect 475 mark-to-market accounting on securities, and if you have a loss in futures, you should elect it on that too, if you can't do a 1256 loss carryback, to lock in that loss as a business ordinary loss, not to dig a bigger hole of capital loss carryovers. We're going to elect it on your individual basis. Then we can revoke it next year if you have a capital loss carryover still and you haven't used it up yet with investments or otherwise. Or we can get you into an entity which is a do-over for the 475 election. So your existing individuals and partnerships elect Section 475 for 2016 by April 15, 2016. Now, if you have an existing SCorp, it's March 15th. That's right around the corner. You send an election statement on a piece of paper with your name, ID number. We have the statement in our guide, the Green's 2016 Trader Tax Guide. You send it to the IRS. How? You attach it to your 2015 tax return, which probably won't be ready. You'll probably be filing an extension, which is a smart thing to do, because 1099Bs come late. This is all complex stuff. You'll pay what you owe with the extension, and you'll attach the election. Now, don't worry. The second step, you have plenty of time to do. That's to file the Form 3115, and you're doing that with your 2016 tax return. So that's next year. Now, if we set up a new entity, that's a new taxpayer. There's a loophole for that. They get to elect 475 within 75 days of inception of the new entity by internal resolution, not with an external filing to the IRS. So if you miss the April 15th deadline as an existing individual or entity, you can always form a new entity to elect later in the year. If you start trading in July as an individual, you didn't know you had to elect something by April 15th. We earn our salt. We are a very successful company, and we attribute a lot of that to educating traders about 475, consulting them on when and how to make the election right, when to revoke it, and to make sure they don't dig a hole of capital losses, get huge refunds from losses, and get the best tax rates possible on gains. So here's a few considerations. Remember, you can easily revoke it now. The IRS just changed the rules this year, similar procedures to the election. So if you have a large Q1 loss, you elect it. If you also have a large capital loss carryover, that's hanging around still next year, you can revoke the election to use it up if you made money between January and April 15th of next year. So every opportunity to elect or revoke, you got to make the right decision. If you're not focused on that decision, you are missing the boat. Even if you're a highly profitable trader, the mark-to-market exempts you from the wash sales, which you could have at year-end. Now, I'm telling you, I've been dealing with traders since multiple decades. I mean, going back to Green & Company was formed in 1983, and I've dealt with heavy-duty Wall Street traders from the beginning. And the most successful traders, they have years where they can lose a lot of money. They don't want to carry over. They want the ordinary loss. Let's talk about tax treatment. You got to learn the differences between securities, Section 1256 contracts, options, ETFs, Forex, and other popular trading products. Well, securities, those have the higher tax rates, the wash sales, the capital loss limitations, and the accounting challenges. That's your equities, your equity options, your narrow-based indexes made up of 9 or fewer. Most are broad-based, 10 or more. Exchange-traded funds, ETFs, are securities. Bonds, mutual funds, single stock futures. Your 1256 contracts, they get the tax breaks. Lower 60/40 capital gains tax rates. 60% is the long-term capital gain. Tax rate on a long-term gain is pretty much 1/2 of the rate for a short-term capital gain at the highest bracket. The highest ordinary bracket is 39.6. The highest short-term rate is 20%. If you add in the net investment taxes, 3.8% more on short-term or long-term. So it's about, when you do the 60/40 math, it's about 1/3 less. And there's a huge difference throughout the brackets. You know, when you're in the 10% and 15% ordinary bracket, if you're married filing joint making under $75,000, the long-term rate is 0%. So imagine if 60% of what you sell is at 0% and 40% is at the 10% bracket. Your tax rate is 4%. It's summary reporting, one-page 1099-B, so there's no accounting. And there's the loss carryback election. But if you're a securities trader and an equities options trader, and that's how you make money, and that's where the action is, and that's what you know, and you elect 475, you can do fantastic. So I'm not telling you to trade futures. I'm just pointing out the differences in the tax treatment. Now, the 1256 contracts include the regulated futures contracts on U.S. exchanges, some foreign futures if they have CFTC and IRS approval for 60/40. Most don't. In our guidance site, we tell you which exchanges have it, like DAX. The broad-based indexes, the E-minis. The options on the broad-based indexes. So it's made up of 10 or more. So if it says S&P 500, NASDAQ 100, Russell 2000, that's all 10 or more. That's all broad-based. That's 1256. Forward Forex, if you make the opt-out election from 988. Options on commodity futures ETFs, those are publicly traded partnerships, and other non-equity options. Now, exchange traded funds, ETFs. When you sell a security or a commodity ETF, it's a sale of a security. If you sell a precious metals ETF, like the GLD, a Granted Trust, then the collectibles rate is going to apply on the long-term portion of, and you'll have a rate up to 28%. A commodity ETF, that's a publicly traded partnership. It's not a registered investment company, a RIC. So you might get a K1. So you got to pick up the pass-through income, which might include 1256 treatment. But again, if you sell the commodities ETF, like the USO, it's a security. But here's what you got to do. You need to manually go into TradeLog and adjust the cost basis for the pass-through income, because no program picks up K1 pass-through income. You got to make that manual adjustment. If you're using TradeLog, you got to make adjustments for corporate actions as well, if you have any. Usually, if you're actively trading, you won't. Now, ETF options are not clear. Options on securities ETFs, those are securities because the ETF is a security. It's like an equity option. Options on commodities ETF, we feel can be 1256, like a non-equity option. Options on precious metals are not clear. We think it's likely 1256. So your equity options are securities, and they include your stock options, your options on your narrow-based indexes, and the options on your securities ETFs. Now, I want you to go and read my blog post on tax treatment for options, because you have the simple versus complex options. Complex options have straddle, potential offsetting, position adjustments. For the simple options, you got the exercise, holding period issues. It's all in that blog post, and it's in the Green's 2016 Trader Tax Guide. I'm going to give you a coupon for that at the end. Now, your non-equity options, those are your options on futures, options on the broad-based indexes, the options on the commodities ETFs. Those are all 1256. Not every brokerage firm breaks this stuff down right. If you run TradeLog, it will break it down right. What's 1256, what's not. That's another really good reason to use good software. Now, we're always working with different software companies to find what works. Some other softwares do it the way the brokers do, like Gainskeeper and Cyvantage. They don't do it based on taxpayer rules. They do it on identical positions. We're hoping they change soon. But we are out there scouring the landscape to find other solutions that work for traders. Forex is a whole different world. It's ordinary gain or loss in Section 988, summary reporting, but you can make a capital gains election to get into lower 60/40 rates if it's on the major currencies only. Probably you Lightspeed traders are not trading spot Forex, so you can learn more about spot and forwards and OTC in our guide, and we have upcoming webinars on that. ObamaCare taxes. Learn about ObamaCare taxes, including the health insurance mandate, the premium credit, the clawback, the penalty, and also the net investment income tax. So you got the mandate for individuals. If you receive subsidies through an exchange, that's good. It's good that you went through an exchange. But now you have to file Form 8962, and you got to square up with the IRS. You gave them an estimate, and they said, okay, your income's low, we'll give you a big subsidy. Well, if your trading gains were much higher than you estimated, because it's very hard for traders to estimate, there's a clawback. You got to pay them back a tax liability. Now, on the other hand, you estimated income and you have some big losses. Well, you're entitled to a premium credit because your subsidy wasn't big enough. Now, if you didn't have ACA compliant health insurance, see if you qualified for an exemption of financial hardship, and they're very generous. But if you don't qualify for an exemption and you can't get your documentation right on that, you're going to owe the penalty, the shared responsibility payment. It jumped up to 2% of household income for 2015, or the higher of $325 per adult, $163 per child, or $975 for the family. So if your household income is $100,000, you got to pay $2,000 penalty, not the $975. Now, on the other side of the spectrum, you have your Obamacare. You're making a lot of money. Well, President Obama said, if you are a high-income taxpayer in the 2%, you're making over AGI 250, it's 200 single, you're subject to tax hikes. So tax rates went up and the net investment income tax came into play. 3.8% Medicare surtax on unearned or investment income affects upper income taxpayers. It only applies to individuals with net investment income, NII, and modified adjusted gross income exceeding 200,000 single, 250,000 married. So if you are a full-time trader, all your income is investment income from trading, and you make 300,000 and you're single. Well, you're over the AGI threshold of 200,000 by $100,000, so you pay $3,800 of the Medicare surtax. Now, in general, the unearned income or investment income includes interest, dividends, rents, royalties. That's in bucket 1. Capital gains and losses are bucket 3, and investment companies and passive losses are in bucket 2. But the IRS agreed that investment company capital gains can also go in bucket 3. We had to get them to fix that, by the way, because you can't take a loss from one bucket against another bucket. Traders went from being the worst off to the best off after we had a petition and we fought for this in Congress. And others fought too, of course, AICPA and others. It wasn't just us. And now if you have Section 475, you can use it against losses against all your other buckets. So there's a lot of stuff I just threw at you today. We just spent an hour doing it. We have a few more minutes to go and then we're going to wrap up. But I want you to go and get the guide. It's really very valuable. There's all this explained. By the way, there'll be this recording. You can go back and watch it again, take your time. I offer you 15% off. Now, when you go to the website, there's 10% off right now through the end of this month, and you get an additional 15% off through March 15th. If you wait for the 10% to expire, you won't see that as well. So get it right away. Use the coupon Lightspeed when you check out. I encourage you to have a consultation with me. That's $150 for 30 minutes. I encourage you to hire us for tax preparation and planning. You saw it's very tricky. You can have a 15-minute session to get a price from us, meeting with my partner, Darren Neuschwander. Use our accounting service. We'll use our professional license to trade log. It's a better deal than a retail license if it goes really fast. If it takes more time, then it might be less expensive if you did it on your own. But then again, it may be very complicated for you to do it on your own. You want an entity? We have an entity formation service. Read about that on the website. So chat with Julia now. Give us a call, the 800 number, 888-558-5257. Go online to do the chat. Click on the website address, GreenTraderTax.com. You can go to the website here. Now, Rob, if we have a few more minutes, I can take a look at a few questions on the board. How do you want to go?
Yeah, let's address some of the questions you see that are pretty general.
Okay. And Rob, when you do the recording, you could end it now. Thank you, everyone, for coming, but we're going to stay on to do some questions, or you can continue with questions as well. Let's see here. I'm not going to say full names to protect people's names. But just first names. Philip, has LS sent out the IRS tax info? Not yet. Rob mentioned it's coming soon. He said early next week, I believe. Carlos, contact information. Just go to GreenTraderTax, and I can actually bring up the website itself here. Go off the PowerPoint now, and make sure that that's a full screen. Okay. And here's the Contact Us page, where you can see information, fill out that form. Okay, one second here, back to the questions. All right, so Jordan, yes, there will be a recording. Rob's going to produce it, put it up on the Lightspeed site. Ronald, we did talk about LLCs. We didn't spend a lot of time on the entities. That's worthy of its own session. There's a whole chapter in Green's 2016 Trader Tax Guide on the entities and another whole chapter on retirement plans. Definitely get the guide. I guarantee it's going to save you a lot of money. Sorry if the sound cut out on anybody. Courtney, I think the sound was okay, right, Rob, throughout?
Sounded good to me as far as I can
Good.
tell.
Okay, so if anyone had problems, go back and watch the recording. Or best to create an entity start of the year. No, not necessarily. You can start it now, have the sole proprietorship year to date, and then the entity now through year end. Don't wait. Get started now so you can make some nice money in the entity to do a nice retirement plan contribution. You're going to wait to see about the profits and do the payroll in December. You're not going to start the payroll now. And you can't get the health insurance deduction unless you have the entity open. So you're not going to get the deduction for January and February, but you can for March through year end if you have the entity for March through year end. John, holding period, lots of short term. I don't see the full question there. 1 second. Let's see here. I have it now. Okay, it's a little detailed to answer quickly. I'm not going to, some people ask multiple questions. I'm going to try to get one per person. Roth IRAs, Z, trading in those are permanently tax-free. It's a great idea to trade in your IRA. Read a lot of our content on retirement plans. There's a lot of stuff to consider, including Roth IRA conversions. 1099R income is income. Darryl is a wash sale rule only at December and January. That's when you got to worry about it in your taxable account, but you also have to worry about it throughout the year with your IRAs. Those are permanently lost. But you're absolutely right. Don't get so worked up about the wash sales all year long. Just break the chain at year end. Don't get back into the position and have it not be a wash sale at year end. Rick, you asked about different symbols. They could have high market move correlation, but they're not substantially identical. Let's see. Okay, Stephen, if you elect 475, what do you do with the wash sales reported? Well, you just ignore it. The 1099Bs are prepared for the quote-unquote everyman. The broker's not supposed to know your tax status and customize a 1099B for you. They're prepared for the everyman. Your tax return is prepared for you. That's where it's customized. And by using 475 in the return, the IRS knows that, and it's in the footnotes. That's why it's very unlikely your return is going to match a 1099B ever. And there's going to be differences. And again, it's explained in the footnotes and through the status. SS. Can you carry forward NOL if you don't need the losses? Well, you're going to apply it. It's a tax software thing. You can't turn on the switch and turn it off. So, yeah, if you're carrying it back to a year where you're at a low tax rate and you have wasted itemized deductions, yeah, that's unfortunate. So you want to do your planning as best as you can. Now, if you have a large NOL for 015, in 014 and 013, you had very low income years. You know the NOL is going to use up low tax rates and waste itemized deductions. You can elect to forego the NOL carryback and carry it forward instead, and then offset it against any type of income, including your spouse's wages. So that's a case where you would forego the carryback with an election on your return. A lot of you have multiple questions, so I encourage you to have a consult with me, RF. Yeah, the 30 minutes you get 150 with me. You see I talk pretty fast, and I'm going to make notes. Make sure you understand everything, even if we go longer, and send you all the notes at the end so you know if you qualify for trader tax status. You know if you need an entity or not. Don't just sign up for an entity. You have to do the consult first because I may talk you out of the entity. And then you upgrade to the entity afterwards if it's a good idea. Bo, the 016 guide is much different from the 015 guide. A lot of changes, a lot of new writing. It's important to get the new guide each year. There was an upgrade. If you had bought last year's guide, contact customer support, you can get a lower discount on it. It may have expired, but she'll give it to you. Alexander, assuming we have a large tax loss this year, you probably want the 475 election. And then we can always revoke it or stick with it and use up the capital loss carryover separately. It's really important that you don't miss that boat. I'm glancing at these questions, folks, and then giving you a quick answer. You can see this is not one-on-one advice. At any point, Rob, if you want me to stop, just let me know. Elliot, if you're a futures-only trader, don't elect 475 unless you desperately need it. If you lost 100,000 in Q1 and you don't have any futures trading in the prior 3 years to carry it back against, and you're going to stop trading, of course you elect 475 to lock it in as an ordinary business loss. Then you set up an entity, and you don't elect 475 in the entity, so you go back to lower 60-40 rates on gains that you make in the entity. You get the best of both worlds, the ordinary loss, and 60-40 on the next set of gains. Boy, do people make money by doing 475 right. Sandeep, SPY options. So if you're trading an ETF and it's a securities ETF and then it's an options on a securities ETF, it's security. It's not 1256. But if it's an E-mini and it's an option on the E-mini, it's 1256. Can you trade in an entity without frequency of trades? No, the entity has to qualify for trader tax status. Don't get bad information out there on the internet thinking, oh, I form an entity, it's trader tax status. Most hedge funds don't have trader tax status. They don't day trade or swing trade. They're more position traders. So you still need to qualify in the entity. So if you traded year to date as an individual, you're starting all over again in the entity. And again, it's annualized. Mark, how do you treat short-term capital gain, long-term capital loss? Schedule D will all consolidate. So everything from any bucket will consolidate on Schedule D. Courtney, where am I located? Today, I work most of the time in Connecticut, but I also work from my home office in New York City. We have CPAs around the country, but our main production is down south. We're entirely a virtual firm using best practices, operating in the cloud with secure encryption, incredible procedures so there's no identity theft or any kind of problems with the best CPAs in the business. It's real easy to work with us. You're just going to upload a share file, which is the most secure portal for exchanging data with CPAs. And then you have Skype meetings or GoToMeetings, video meetings. It works wonderful. So, Rob, I think I got to most of the questions. I want to thank everyone for coming.
Philip just wanted to know, if you had a mark-to-market election at a previous year, does that carry over? Does that expire at a certain time?
No. Once you elect 475, it sticks with you as long as you have trader tax status. So if you have it through June 30th, 2015, and stopped trading and just did investing afterwards, you would use it to June 30th only. Then it's suspended, and you would file as an investor for the rest of the year. And then by this April 15th, you could revoke the election if you want, or just leave it suspended to be reused again whenever you requalify. And that's all in the guide as well.
Great. Okay, yeah, I think that pretty much wraps up most of them. Certainly, like Bob said, the video is going to be on our website in a couple of days for everyone to review and to use as a resource, and certainly visit Bob's site and reach out to him and his services. Like I said, he is the authority on trader tax status. So Bob, we thank you so much for presenting here. We hope everyone got a lot out of this. I'm sure it was a lot of information, but a lot of great information. So we can't thank you enough, and we hope people do take advantage of this and also reach out to you and take advantage of your services as well.
Thank you so much, Robin. It's great to work with Lightspeed.
Great. Thank you so much. Everyone have a great night. Bob, take care. Thanks.
Thank you. Good night.